Global equity markets continued their volatile campaign, with the FTSE All-World Total Return Index falling 8.4% over the month as economic data releases remained lackluster. This brings the year-to-date drawdown to 19.7%. Similarly, the FTSE World Broad Investment Grade Bond Index declined 3.1% in June, bringing the year-to-date drawdown to 14.3%, amid a higher than anticipated US CPI print and a slightly more hawkish Eurozone central bank. The investing environment remains highly uncertain, as evidenced by the historically elevated VIX and MOVE index levels representing US equity and bond market volatility indexes respectively. It is worth noting that inflation expectations, as proxied by the US 10-year break-even inflation rates, are lower on a year-to-date basis, as a deteriorating growth outlook suggests that demand pull inflation will likely abate. Moreover, the Bloomberg Commodity Index fell 10.8% over the month, providing some respite for a more sustainable inflation trajectory going forward. The US Federal Reserve delivered a 75 basis points hike over the month amid the highest inflation print since December 1981, which came in at 8.6% year-on-year in May. As at the end of June, federal funds futures markets have priced in a further 179 basis points worth of hikes before year-end, as taming inflationary pressures remains at the epicenter of the central bank's mandate. In fact, the Federal Open Market Committee increased their PCE inflation projections this year to 5.2% from 4.3% previously, and GDP forecasts were lowered to just 1.7% from 2.8% previously, while signaling a swifter hiking cycle as displayed in their dot plot projections. While the ECB and UK also intend to tighten monetary policy further, the Bank of Japan remains on a divergent monetary policy path, reaffirming their commitment to accommodation. This has put enormous pressure on the Japanese yen and the Bank of Japan's yield curve control program. Overall, global economic data releases continue to slow, with confidence metrics trundling at depressed levels. This is particularly the case in the developed markets. One bright spot, however, is the reopening of the Chinese economy, leading to upside surprises in recent economic data releases. While we are cautious of sudden lockdowns being erected again, low relative valuations compared to other equity regions are making the investment case attractive. Moreover, supportive liquidity dynamics, a notable turnaround in the credit impulse, and well-contained levels of inflation underpin a much more upbeat macroeconomic backdrop. Then lastly, and encouragingly, COVID-19 cases continue to abate as the global vaccination rollout continues to make significant headway. In fact, according to Our World in Data, 61% of the world's population was fully vaccinated as of 30th of June 2022, compared to 60% in the previous month.